Have you ever seen an ETF paying 10% plus income every month, but no one's really talking about it? Not one of those overhyped names like MSTY or ULTY. I'm talking about something that actually earns its yield from real cash flow, not wild options on a single stock. If you stay with me for the next few minutes, I'll show you exactly what it is, when it launched, what it pays, and how it can fit into a smart income portfolio. We'll even see what $100,000 invested here could turn into over the next 5, 10, and 20 years. Let's start with the big idea. This fund collects income from America's energy infrastructure, the massive pipeline networks, gas processors, and storage systems that literally keep the economy running. And then it sells covered calls on those same assets to turn market volatility into cash flow. It's like collecting tolls from energy pipelines and rent from the stock market at the same time. Most investors never look here because they're distracted by flashier tech funds. But this sector has quietly been a cash machine for years, with long-term contracts and stable fees that don't swing as wildly as oil prices themselves. When you add a disciplined options overlay, you get consistent monthly income that can beat many popular covered call ETFs. Now, the big reveal. The fund is called the Global X MLP and Energy Infrastructure Covered Call ETF, ticker MLPD. It launched on May 2024 and it's still flying under the radar, which is surprising because it's paying some of the highest yields in the entire ETF market. Here's the snapshot straight from the provider. Expense ratio is 0.60%. Pays every month. Trailing 12-month distribution is 12.29%. Current distribution rate is 10.5%. That's the actual income investors have been receiving, according to Global X as of November 2025. The holdings behind that income are familiar and powerful names: Williams Enbridge, TC Energy Kinder, Morgan Chenier, and ONEOK. Together they make up about 0.67% of the fund, and they're responsible for moving most of North America's natural gas and energy products. These companies earn stable cash flows from transporting fuel, not from betting on prices, and that's what makes their income reliable. Performance so far. From its launch through the end of October 2025, MLPD delivered about 14.5% total return at net asset value. Now let's make this real with a simple example. If you invested $100,000 and the current distribution stayed around 10.5%, you'd receive about $10,500 per year, paid monthly. That's roughly $875 every month landing in your account. If you simply took the cash and never reinvested it, that's over $52,000 in 5 years and about $210,000 in 20 years, without assuming any price change. If you chose to reinvest the monthly income, the compounding could make it even higher, though it depends on future performance. But remember, this isn't a magic money machine. Covered call income can change with volatility. When energy stocks move sideways or modestly up and down, option premiums are strong and income is high. But when markets surge straight up, your upside gets capped, and if energy prices crash, your payout could dip temporarily. Still, what makes this fund unique is how it bridges two worlds: the dependable cash flow of midstream energy and the income-generating power of covered calls. That combination is what allows 10% yield without extreme leverage or complex derivatives. Now, if you want to take it a step further, you can build a balanced income duo. Pair this ETF with the Brookmont Catastrophe Bond ETF, ticker ILS, a completely different beast that earns yield from insurance-linked securities instead of stocks. Cat bonds pay investors to take on a small slice of natural disaster risk, which rarely moves in sync with the stock market. That means when markets stumble, those bonds can still generate returns. Put together, MLPD and ILS give you two income engines driven by totally different forces, pipelines and weather. It's a rare way to smooth your overall cash flow while keeping yields high. So where does this fund belong in a portfolio? Think of it as a satellite income position, not your core S&P 500 holding, but a piece that boosts your overall yield. Because it's concentrated in energy infrastructure, most investors might allocate something like 3% to 6% of their portfolio here. It's perfect for the income section or alternatives bucket, anywhere you want steady monthly cash flow without full market dependence. The biggest reasons investors like this fund are its simplicity and transparency. It holds visible cash-generating companies, sells calls the same way every month, and pays investors regularly. There's no mystery, no algorithmic leverage, and no crypto wrapped in buzzwords, just contracts, pipes, and premiums. Let's talk about what to watch out for. Energy infrastructure can still feel the effects of commodity cycles regulation and changes in demand. Covered calls limit your upside in strong bull markets. And because the fund includes return of capital in its payouts, the distributions may not all be income for tax purposes. They may reduce your cost basis instead. Always read the tax section on the issuer's site or talk to a professional before buying. So, is this fund better than the famous high-yield ETFs everyone talks about? In many ways, yes. It trades a bit of headline yield for better diversification and a far more understandable income engine. For investors who want strong cash flow with less risk of collapse, that's a pretty good trade-off. And the timing is right. With interest rates expected to drift lower in 2026, high-yield income funds with real cash flow could outperform bond-heavy portfolios. While others chase AI stories or speculative tech, income investors are quietly building cash machines that pay them every single month. If you've been hunting for a high-yield ETF that most people haven't discovered yet, this might be one of the most compelling ones on the market right now. Before we wrap up, here are 3 quick rules for every income investor. First, never chase yield blindly. Understand where it comes from. Second, diversify across different income sources, not just different tickers. And third, always focus on total return, income plus growth, not yield alone. If you found this breakdown helpful, make sure to subscribe to MoneyQuest Broker and turn on all notifications so you don't miss our next deep dive. I post weekly videos unpacking the newest ETFs, yield opportunities, and strategies to grow your portfolio safely. And one more thing. This video is for educational and informational purposes only. It is not financial or investment advice and not a recommendation to buy or sell any security. All fund data come directly from the Global X website as of November 2025. Distributions can include return of capital and will vary over time. Examples and projections are hypothetical and for illustration only. Always do your own research or consult a licensed financial advisor before investing.